we will discuss in a little bit what mean reversion means. But before we do that, we have to discuss the concept of stationarity, because stationarity forms the basis of mean reverting strategy. A time series is called stationary if it doesn't wander off to infinity as time goes on. Now, a random walk or a geometric random walk, for those who are sophisticated, is not a stationary time series. So, for example, let's look at the price of gold as represented by the ETF GLD. It is undergoing what we call a geometric random walk, and this is the time series. It doesn't seem that it will ever stop going up. Okay. And similarly, if you look at the gold mining stocks, ETF, GDX, it shows a similar behavior. There's no particular pattern to it. It just looks like a random walk, going farther and farther from the mean. Okay. However, here is an example of a stationary time series. You can see that it doesn't, it shows a distinct pattern. In fact, the pattern is obvious that you can call it mean reverting, because it looks like it is always going, you know, whenever it's very far from, let's say, an imaginary line here, it tends to come back. It's very mean reverting. And now, if a price series that we trade is like that, it's stationary, it is obvious that we can trade it quite simply by a mean reversion strategy. What is a simple mean reversion strategy? Well, you must have heard of it. It's just buy low and sell high, and vice versa. Short it when it's high and buy cover when it's low. Just doing it over and over again will earn you unlimited profit. And in fact, that's what a lot of statistical quantitative traders do. Right? Mean reversion strategy is one of the basic money makers. Been for many years for quantitative traders. But how do we know whether a time series or price series is suitable for this kind of strategy? Not every price series, as we've seen, most price series are not mean reverting and they're not stationary. So how do we test very quickly to see if a price series fit this criteria so that we can trade this mean reverting strategy? Well, that brings us to what is called the ADF test. It's a statistical test which tests whether the change in price in the next period meaning next bar, it could be 5 minutes bar, it could be 10-minute bar, but whatever it is, let's look at the change in price in the next bar. Is that going to be proportional to the difference between the current price and the mean price? If it is not proportional, it is a random walk, right? A random walk, the price change in the next time period is independent, is a white noise. You could not predict what the next price changes. It could be positive, it could be negative, it could be zero. But for a stationary price series, it is predictable. In fact, it is going to be negatively proportional. It is going to be negative proportional to the current price, to the difference between current price and the mean price. Or to put it other way, it is proportional to the mean price minus the current price. As if the current price is very low compared to the mean price, the change in the next period is likely to be up, right? So that's what mean reversion means. If it is below the mean, it tends to go up. If it is above the mean, it tends to go down. That's why it revert to the mean. So it will revert to the mean only if there is a proportionality constant that is different from zero and is particularly negative. So the statistical test is actually capitalized on this observation. It is testing whether the regression coefficient between the next period price change and the current difference between the mean and the price. And if we can reject the null hypothesis that that proportionality constant is zero, then there's a likelihood, there's a good likelihood that this price series is stationary, that it is mean reverting. I'm using mean reverting and stationary synonymously at this point. Okay, so that's called the ADF test. It's nothing but a statistical significant test of the regression coefficient to see if it is zero or not.